All right, let's bring in Stephanie Link of Hightower Advisors, Eric Johnston of Cantor Fitzgerald. Stephanie is a CNBC contributor. It's good to see both of you. Eric, I'll go to you first because you're still super negative. And I'm wondering what still prevents you from being positive even incrementally, because you seem to be doubling down every time you come on.
Yeah, there's not a lot to be positive about. We would disagree with this newfound view that the chances of a soft landing, no landing, or the chances of a recession going down, we would disagree with that view completely. I think if you look at all of the coincident indicators, payrolls being one of them and the current strength of the consumer, they're doing great, right? Labor market remains, somewhat tight, but that's not a forward-looking indicator. If you look at the forward-looking indicators and you look at things like the fact that we're at 3.4% unemployment rate, which is by definition the top of the cycle. There's a delayed reaction to Fed hikes to some degree, whether it's 6 months or 2 years. The leading economic indicators negative for 10 months in a row. Consumer excess savings, they still have, but it's going down by the day and will likely be zero by the middle of the year. Credit usage is surging. All of that, I can go on, all of the leading indicators suggest that the economy is going to decline throughout this year and will likely go into some sort of recession, but for sure will be in decline. And if you look at prior to all prior recessions, people were calling for soft landing and payrolls were very strong. And we see that changing. And what makes our conviction so high is that valuations, and this was touched on earlier, valuations right now are excessive. The equity risk premium is 1.5%. To put that in perspective, the average over the last 10 and 20 years is 3.2%. If we were to go to 3.2%, that would be 3,100 in the S&P 500. So valuations are excessive and earnings estimates are still too high.
All right, Steph, you can debate with the best of them, so have at it, because Eric's view is so different from yours, it's striking.
Well, yeah, so I agree that payrolls are a lagging indicator, but initial claims are a leading indicator. And you are now, again, another week of sub 200,000 in initial claims. And you're down on the 4-week moving average about 6% year over year. So labor market's still very tight. Wages are still strong. Even though they're coming down a little bit, they're still strong. So real incomes are actually going up for the consumer. And I would just simply point out that the consumer, it's not all gloom and doom. I went back and I looked at Walmart, Kroger, and Dollar General on a 3-year stack basis for comps. That is an indication of demand. And Walmart saw a 24% increase on a 3-year stack basis to comps. Kroger at 22% and Dollar General of 17%. This is just an indication of what companies are telling us that they're seeing. And so the consumer remains strong. Resilient is the word that I would use. And then also I would look at the ISM services and the composite numbers. The Chicago Federal National Activity Index came out. It's the first positive number that came out in 4 months. And so there is underlying momentum. And yeah, this is also leading to stubborn, sticky inflation. And it's not going to change the Fed's path, but I kind of think the economy is so much more momentum than it's getting credit for. And I think that's going to translate into better earnings. Not great earnings, Scott, you know that, but not a collapse by any means, because I do think overall everyone's talking about the expensive market, but I think that the E is wrong. I think the E is going to be better than people suggest.
In other words, Eric, you're too negative. You're not focusing on any of the positives. You just assume that the Fed has done a lot, and it's ultimately going to have a toll on the economy and the consumer who's going to run out of money, and delinquencies are going to pick up even more than they already have on credit cards, and this whole thing is going to come eventually to an end.
So what's great about our view is that even if earnings don't go down at all, the market is still overvalued at this price. So if we have this great perfect landing, we have growth, inflation comes down, Fed stops hiking, stocks are still too expensive and will likely move lower. Now, here's what I would tell you around earnings. On October 1st, of last year, the estimate for the next 12 months was $235. We've now had 2.5% GDP in the fourth quarter. We're looking like 2.5% in the first quarter. And the earnings estimates have gone down from 235 to 220. That's in a 2.5% GDP growth environment.